Welcome to the third video in a series where we explore the private credit industry, a sector that has seen remarkable growth and transformation over the past decade. With more than $2 trillion in assets by the end of 2023, private credit has become a vital component of the financial landscape. In 2023 alone, private credit players deployed an estimated $333.4 billion of new capital, a significant rise from the $203 billion invested in 2022. Private credit firms have enjoyed a golden moment, as Blackstone President Jonathan Gray put it, while banks have been on the back foot from the sharpest increase in interest rates in 45 years. In 2023, these non-bank lenders funded a whopping 86% of leveraged loans, up from 61% in 2019, according to PitchBook Ltd. But as we look to the future, we might wonder, what lies ahead for this fast-moving industry? Today, we'll delve into two critical variables that could shape the future of private credit: the scarcity of capital and the degree of disintermediation of banks. Let's start by defining these terms. Scarcity of capital refers to the availability of financial resources for investment. Will we live in a world where capital is easily accessible, or will it become a rare resource? Disintermediation of banks, on the other hand, refers to the growing role that non-bank organizations play in the lending process that banks have historically played. Will banks continue to play a significant part in the financial system of the future, or will their influence continue to wane as it has in previous decades? The private credit industry emerged during a period characterized by exceptionally low interest rates and significant regulatory pressures on banks. After the 2008 financial crisis, central banks around the world implemented aggressive monetary policies, including quantitative easing, to stimulate economic recovery. This led to a prolonged environment of cheap and abundant capital, where borrowing costs reached historic lows. As a result, private equity buyouts surged, creating fertile ground for private credit to flourish. With banks retreating from leveraged lending due to stricter regulations, private credit firms stepped in to meet the growing demand for alternative financing solutions. This gap in the market allowed private credit to grow exponentially, with firms like Blackstone and Apollo leading the charge. But what happens if we find ourselves in a future where capital is scarce? If capital becomes harder to access, private equity buyouts may lose their appeal, but this could also open doors for new opportunities in project financing and specialty lending. Now, let's turn to bank disintermediation. This trend has been ongoing for decades and can be traced back to several key events. In the 1970s, when inflation and interest rates surged, many companies began seeking alternative sources of financing. As interest rates climbed, businesses turned to the capital markets, issuing commercial paper and bonds instead of relying solely on bank loans. The rise of high-yield bonds in the 1980s marked another significant wave of disintermediation. Companies discovered that they could bypass banks entirely by tapping into the bond market, leading to a dramatic shift in how businesses financed their operations. This trend continued into the 1990s and 2000s, as advances in securitization allowed a broader range of borrowers to access capital without traditional bank involvement. Fast forward to the aftermath of the 2008 financial crisis, and we see another critical juncture. Banks faced heightened regulations and scrutiny, which further restricted their ability to lend. As a result, mid-market corporations and mortgage borrowers increasingly sought financing from private credit firms, leading to a significant shift in the lending landscape. The share of bank lending in the U.S. economy has fallen dramatically, from 60% in 1970 to just 35% today. This historical pattern clearly outlines how financial regulations often accelerate the progress of this disintermediation. Historical regulations, such as Regulation Q, which imposed ceilings on interest rates offered to depositors, have led to deposit flight to alternative financial instruments. Similarly, current regulatory frameworks can push borrowers toward non-bank lenders, further entrenching the trend of disintermediation. As we move forward, we will examine three possible scenarios based on our two key variables: abundant versus scarce capital and deep versus shallow disintermediation. What do these scenarios mean for private credit? Join us as we navigate the future of the private credit industry and the potential paths it may take. Now that we've set the stage, let's dive into our first scenario, the Goldilocks scenario. This is the scenario where everything seems just right for the private credit industry, where bank disintermediation deepens alongside an abundance of capital. In this scenario, we find ourselves in a financial landscape defined by regulatory limits on banks and the development of innovative financial products. At the same time, we continue to live in a world awash with capital, much like what we've experienced over the past decade. Financing costs for enterprises remain low, with debt costs in the low single digits and interest rates hovering near zero. This environment fosters a thirst for returns in a low-interest, yield-starved world, pushing more capital into private equity and, consequently, private credit. One of the most significant implications of this Goldilocks scenario is the expected increase in assets under management within the private credit sector. According to JP Morgan, allocations to corporate direct lending, comprising more than half of the total $2 trillion private credit universe, are projected to increase further. New and larger funds are entering the market, signaling robust demand for private capital. JP Morgan estimates that global private debt assets are around $1.8 trillion today and could exceed $2.5 trillion by 2027. This growth is particularly evident as borrowers turn to private credit funds to refinance their debt, especially during periods of muted leveraged buyout (LBO) activity. The gradual recovery of LBO and M&A deal volumes, which began in the third quarter of 2023, indicates new lending opportunities for private credit funds. On a risk-adjusted basis, there is a strong preference for senior secured first lien loans, which provide a layer of protection for lenders. In addition, the private credit industry has demonstrated remarkable resilience, even amid higher interest rates and geopolitical challenges. Deal flow remains robust, and lenders are maintaining selective underwriting practices to ensure the quality of their portfolios. According to EY, private credit managers have consistently upheld their lending standards, ultimately investing in only a small percentage of the deals analyzed. As Neil Broadhead, a partner at CVC Credit Partners, noted, our portfolios have managed a pandemic, wars, supply chain issues, and inflation. The portfolios have seen all of that and been remarkably resilient. This adaptability underscores the value of private credit as a reliable source of financing during turbulent times. Another significant implication of the Goldilocks scenario is the potential for increased consolidation within the private credit market. The bulk of private credit's growth over the past decade has been concentrated in direct lending strategies, which historically have primarily financed highly leveraged mid-sized companies typically owned by PE. A lender's ability to anchor or lead a given facility through a scaled commitment continues to be advantageous in both access and deal terms in this market. In 2023, the largest 20% of private creditors deployed almost 80% of capital in the industry. According to EY, investors are currently favoring larger managers who can deploy capital at scale. Larger managers are better positioned to provide a wider range of investment strategies and tailor products to meet the diverse needs of their clients. This trend is indicative of a broader consolidation across the asset management landscape. As you can see in this illustration, we see a significant increase in acquisition activities in the private credit space in 2023 to 2024 compared with other periods of time. Recent data also indicates that larger private credit managers are acquiring specialist lenders to expand their footprint in the asset class. This consolidation not only allows for economies of scale, but also enhances the ability to access larger mandates that encompass various areas of expertise. Sonia Rocha, head of research for European middle market private debt at BlackRock, emphasizes the importance of maintaining established and experienced investment teams to stay competitive in the core mid-market. As the market consolidates, only the largest players may effectively compete for substantial financing, particularly in investment-grade companies and major infrastructure projects. Finally, the Goldilocks scenario could pave the way for greater access to private credit for retail investors. As the industry remains active and in search of capital, asset managers may develop products that allow retail investors to gain exposure to private credit. For instance, Blackstone has partnered with BNP Paribas to launch a fund aimed at French retail investors, tapping into a large pool of savings held by individuals through tax-efficient life insurance products. This initiative reflects a growing trend to democratize access to private credit investments, which have historically been the domain of institutional investors. Currently, private credit has only a 2% to 3% penetration in private wealth outside the US. However, with regulatory frameworks like the European long-term investment funds gaining traction, there's potential for significant growth in this area. Private credit managers seem cautiously optimistic about the potential of retail capital, but they also provided some important caveats to that view, particularly around the opportunity cost when marketing to retail clients. To attract retail capital, marketing efforts need to bear in mind that the key competitors are traditional 60/40 strategies, and firms need the right operational structures and processes in place to deal with retail investors at scale. Operational challenges around valuations must also be managed, particularly in liquid or semi-liquid funds where there is monthly or more frequent liquidity, but valuations are carried out on a quarterly basis in line with the standards of the asset class. Deborah Zerko, Global Head of Investments at Allianz Global Investors, put it, "Democratization is a positive move for investors and for the markets, but we must not ignore its challenges. It is critical that every asset manager acts responsibly, especially during the formative stages, when regulatory frameworks are still developing and investor education is crucial." In conclusion, the Goldilocks scenario presents an intriguing outlook for the private credit industry. With abundant capital, regulatory limits on banks, and a growing appetite for private credit, the stage is set for further growth and innovation. As we continue to explore the evolving landscape of private credit, it will be fascinating to see how these dynamics unfold in the coming years. Moving on, we will explore the second scenario, blurred lines between public debt and private credit. This scenario presents a different world where the boundaries between public and private lending become increasingly indistinct. In this scenario, capital remains abundant, much like the previous decade. However, the progress of bank disintermediation may be tempered due to various factors. One potential catalyst could be a shift towards deregulation, as highlighted by JP Chase CEO Jamie Dimon, who noted that bankers were dancing in the street following Donald Trump's election.
I think it will, the banking industry, whether you voted for Trump or Joe Biden, a lot of bankers, they're like dancing in the street because, they've had successive years and years of regulations, a lot of which stymied credit.
This deregulation could enable banks to reclaim some territory in the lending landscape, allowing them to compete more effectively with private credit firms. Alternatively, the private credit industry could experience a systematic crisis, prompting regulators to adopt a more cautious stance toward the private market. While the exact triggers for this scenario remain uncertain, the assumption is that private lenders may lose some of their momentum, allowing banks to regain influence in the lending space. Despite these challenges, the private credit industry is unlikely to disappear. Instead, we may see an evolution where the lines between public and private debt blur significantly. This scenario suggests an increasing collaboration between banks and private lenders, fundamentally reshaping the financing landscape. As banks and private lenders begin to work together, borrowers may first turn to private credit for its flexibility and certainty, only to later refinance their debts in the public market when conditions are favorable. The Economist notes that private credit funds offer speedier deal-making and more pliant terms, making them attractive to borrowers facing pressure from high interest rates. Analysts at JP Chase reported over $13 billion in refinancing deals in 2024, with borrowers securing coupons that are, on average, 1.6 percentage points lower than their private loans. This trend illustrates how borrowers can leverage private credit initially, but then seek out public markets to optimize their financing costs. With further recalibration of bank regulations likely and the restructuring of U.S. regional banks, opportunities for partnerships are expected to increase, marking a shift from the previous model where private credit sought to bypass banks entirely. Recent reports indicate that at least 10 partnerships have been announced between major banks and private credit firms in the past year. For example, Apollo and BNP Paribas recently launched Eliant, an inventory solutions platform aimed at working capital and supply chain needs. This partnership exemplifies how banks and private credit firms can work together to provide tailored solutions to borrowers. Collaborations of this kind allow banks to optimize their balance sheets while leveraging the agility and flexibility of private credit firms. These partnerships benefit both parties. banks retain their origination platforms and primary customer relationships while minimizing the commitment of their balance sheets. Private credit firms gain access to banks' extensive origination capabilities and customer bases, allowing them to expand their reach and diversify their offerings. However, this collaboration does come with challenges. As banks and private credit firms work together, they will need to navigate differences in data management and operational structures. Each bank has its own systems for managing and storing data, which could complicate partnerships if not addressed properly. In conclusion, the blurred line scenario presents a complex landscape for the private credit industry. As capital remains abundant and the dynamics of collaboration with banks evolve, the potential for a more integrated approach to lending could reshape how borrowers access financing. Monitoring these developments will be essential as they unfold in the ever-changing financial ecosystem. However, will the world of superabundant capital, in which most investors and managers navigate the majority of their careers, last forever? What about a world where capital is scarce and financing becomes more expensive? In this segment, we will explore the third scenario, rotation in areas of focus. To begin, let's consider why we might enter a capital-scarce world in the 2020s. Several factors are converging to create this shift. First, economic populism is gaining traction, leading to a revival of discretionary fiscal policies. For instance, the $1.9 trillion package signed by President Biden is a testament to this trend. As governments engage in deficit finance spending, the excess savings available for investment could diminish over time. Second, the need for rewiring global supply chains is becoming increasingly evident. The disruptions caused by the pandemic highlighted vulnerabilities in global supply chains, prompting companies to invest more in business continuity. This shift toward nearshoring will require substantial capital, further straining the availability of funds. Finally, climate change is driving the transition to greener energy, which is fundamentally a capital-intensive endeavor. According to estimates, between $100 trillion and $300 trillion of capital will be needed globally to finance the transition to sustainable energy sources by 2050. This urgent need for investment will absorb a significant portion of available capital, making it scarcer for other uses. In summary, the key features of a capital-scarce world differ markedly from those of a capital-abundant environment. In a capital-abundant world, investors are more willing to deploy funds across a wide array of opportunities, often leading to lower returns and increased competition for deals. Conversely, in a capital-scarce world, investors become more selective, focusing on high-quality opportunities that promise better risk-adjusted returns. According to EY, investor appetite for diversification is already driving the market's expansion beyond corporate lending into asset-based lending, ABL, real estate debt, infrastructure debt, and other strategies. Collectively, these strategies currently account for around 40% of private credit assets under management, and their share is expected to grow significantly as investors seek to maintain diversification while increasing their exposure to private credit. Moreover, the private credit sector is poised to play a critical role in financing the global green transition. The need for substantial investment in sustainable infrastructure aligns with the characteristics of private credit, which is well suited to support long-term projects with extended payback periods. As the private credit industry adapts to this new landscape, it will likely focus on specialty finance, which encompasses a broad range of lending secured against physical assets or pools of contractual cash flows. This includes equipment finance, aircraft leasing, and other specialized lending areas that offer higher risk-adjusted yields, making them attractive to institutional investors. The rotation in areas of focus could also lead to the emergence of new products and strategies within private credit. For example, private credit managers are increasingly looking to develop products that offer working capital and cash management solutions, catering to the evolving needs of borrowers in a capital-scarce environment. In conclusion, the rotation in areas of focus scenario highlights a transformative shift for the private credit industry as it navigates a capital-scarce world. While this environment presents challenges, it also opens doors to new opportunities in specialty finance and project financing. As private credit adapts to these changes, its role in financing critical infrastructure and sustainable energy projects will become increasingly vital. As we wrap up our exploration of the future of the private credit industry, let's take a moment to recap the key insights we discussed throughout this video. We began by identifying two critical variables that will shape the future of private credit: the scarcity of capital and the degree of disintermediation of banks. These variables serve as the foundation for understanding how the industry may evolve in the coming years. From there, we delved into three distinct scenarios that could unfold based on these variables. 1. The Goldilocks scenario. In this scenario, we envisioned a world of abundant capital and deeper bank disintermediation. Here, private credit firms thrive as they capitalize on the demand for flexible financing solutions, leading to significant growth in assets under management. 2. Blurred lines between public debt and private credit. In this scenario, we explored a landscape where bank disintermediation lessens and collaboration between banks and private lenders becomes increasingly common. Borrowers may initially turn to private credit for its speed and flexibility, only to refinance in the public market when conditions are favorable. This collaboration could reshape the dynamics of both markets and lead to a more integrated approach to lending. 3. Rotation in areas of focus. Finally, we discussed a scenario where the industry shifts toward a capital-scarce environment. In this case, private credit firms may reduce their exposure to traditional corporate lending and instead focus on specialty finance and project financing. This pivot aligns with the growing demand for capital-intensive investments in areas such as infrastructure and the energy transition. As we've seen, the future of private credit is shaped by a complex interplay of factors, and the industry is poised for both challenges and opportunities. Whether it's adapting to a new capital landscape or embracing collaboration with traditional banks, private credit will continue to play a vital role in the broader financial ecosystem. Thank you for joining us on this journey through the private credit industry. We appreciate your time and interest in understanding the evolving landscape of finance. Don't forget to like, share, and subscribe for more insights into the world of finance and investment. Until next time.